Hey everybody, Mike here again. Now that we understand, if you've watched the previous videos I've put out, you understand now why a dividend-paying whole life insurance is the best tool to use in order to take control of your finances. Today, we're going to see what it actually looks like in practice. Okay, so I've previously talked about the fact that when you make a large purchase, you're costing yourself interest. Okay, you're either maybe paying interest to somebody else through the form of a loan, or you're maybe costing yourself interest that you could have otherwise earned. We're going to dig a little bit deeper into that and see how it actually looks. Okay, in order to do that, we're going to use a purchase of a car as an example. Okay, we're going to suggest that we're going to purchase a car for $20,000, and we'll kind of walk through the different ways that we could do that. Okay, first, one of the ways that you could do it is you could take out a loan in order to pay for the car. Now, when you take out a loan, you'll be put on a payment plan of some sort, which consists of a principal amount, which is a portion of the purchase of the car, plus some interest at a specified interest rate. Okay, that interest is the payment that you're making to the bank as a service for them fronting you the money. Not a whole lot of flexibility generally in these payment plans. They set you up and say this is your payment per month, and you're going to have to make that payment. Okay, now the bank, that's because the bank has lent you the money. They want their money back, and they're going to make sure that they get it back. Okay, now the second thing that you could do is you could pull cash out of a savings account. This means that you don't have to go to the bank and get a loan, right? You don't have to pay interest on a loan as a result, but now that cash is gone. So you don't have access to it anymore. So hopefully you didn't use up all your cash, right? Or hopefully you don't need that cash for something else in the future because it's not there anymore. You'll also have used your cash for something that's going to increasingly decrease in value, right? So the second you purchase that car, your $20,000 that you spent, now the thing that you used to spend that $20,000 on is worth less than $20,000. Okay. The last point I want to make with regard to using a savings account is that you'll likely want to replenish your cash for future use, right? So somebody may say, I don't want to pay interest. I don't want to have a car payment, so I'm going to use the cash. Well, if they don't replenish the cash that they used, then they're going to not have any for future use, right? So they have a car payment still in the form of replenishing their cash stock, but it just looks differently. And in the meantime, that person's lost out on the interest that they could have earned on that cash had they not liquidated it. Okay, the third way that you could purchase a car is you could sell something in order to gain the cash to pay for it. In this case, we're going to use an example of maybe somebody has an investment account with stocks or mutual funds in it. Okay, so you go to your broker and you say, hey, I want to sell $20,000 worth of stuff in order to pay for this car purchase, right? So you go and you liquidate that again. Now those assets are gone. You would presumably purchase those assets to watch them grow in value over time, and maybe they have, hopefully they have. If that's the case, because the market had done well, then there's another consequence associated with this. You're going to have capital gains on the stuff that you sell, right? So what that means is you got to pay taxes now on the stocks or mutual funds that you sold. So you're going to have to liquidate probably more than the $20,000 that you want to pull out in order to account for the taxes that you have to pay. Okay, and again, those assets are now gone. If you want to replenish those assets, you're going to have to purchase maybe at a lower price, maybe at a higher price, but you don't know and you can't control it. Okay. The fourth option, and this is the one that most people don't know about, and this is why I'm making making all these videos, is that you could use a dividend-paying whole life insurance policy in order to pay for the purchase of the car. So let's say you've had a policy in place for a few years now, and you've built up enough cash value to support the purchase of the $20,000 car. So you want to use that cash that's built up in there in order to do that. So what do? You take out a loan from the insurance company. Okay. Now, when you do this, you're not actually using the cash inside your policy. The cash value inside your policy is only used as collateral to account for the policy owner passing away prior to the loan being paid back. Okay. In this case, if that were to happen, say we'll use round numbers, say there was a death benefit of $350,000, and when the policy owner passes away, there was a loan balance of $10,000. The beneficiary would receive $340,000. They would simply deduct the balance of the loan from that, and that way the insurance company is paid back and the death benefit is paid out. Okay. But what happens if the policy owner doesn't pass away during the course of paying this loan back? What happens to the cash value inside that policy? That cash value continues to grow at the full dividend paying rate on the full amount of cash value that's in there. If you had $30,000 of cash value inside your policy when you took the $20,000 loan out, your dividend still gets paid on the $30,000 as if no cash had left the policy. Why is that the case? Because no cash has left the policy. Again, it's only used as collateral. Okay, so that's where these things can become really, really powerful. Here's the other benefit to it. You pay back the loan to the insurance company on your own terms. Yes, you pay interest on that loan, but that interest is part of what fuels the dividend that the company has available to pay at the end of the year. So by paying back the loan to the insurance company, you are essentially paying yourself interest as you do that. Now, as I mentioned, you pay back the loan on your own terms. Okay, so you set the amortization schedule, right? They're not going to come knocking on your door and say, hey, you have this loan out. So could you, in theory, just choose not to pay back the loan? The answer is yes, you could choose not to pay back the loan. Sort of defeats the purpose of the plan, because by taking advantage of the flexibility in that way, you're actually reducing the amount that the company has available at the end of the year to pay out dividends. Now, if you're a small fish in a big pond and you don't choose to pay back your loan, does that necessarily have a huge impact on the amount of the dividend at the end of the year? Probably not. But if everyone used that same thought process and chose not to pay back their loan, it would absolutely impact what the company has available. So the best way to do it is to pay back the loan, and thereby you're fueling your own dividend at the end of the year. We're going to see what this actually looks like in practice. We're going to run over to a spreadsheet that we've built that shows how taking out this loan is going to impact your cash value inside your policy. Okay, and we're going to do that using a simple spreadsheet over a couple of minutes real quick. Follow me over to the spreadsheet and I'll show you how.
All right, so here I'm going to show you in a spreadsheet why using a dividend whole life insurance policy is a powerful tool when doing a purchase like this. And to make it more powerful even, I'm going to use a higher interest rate that we pay back to the insurance company than what we earn inside the cash value. So we're going to start with our $20,000 purchase, okay? And we're going to say that over 5 years or 60 months, we're going to pay this thing back at a 6% interest rate. Now, the monthly payments associated with that, if we just set up our own schedule, would be $387. That would give us a total outlay of $23,199. It would cost us $3,199 in order to take out this loan from the insurance company. Now, what happens to our cash value in the meantime? Remember, our cash value did not change. We borrowed the $20,000, but our cash value stayed there. So what happens to that $20,000 over the course of the 60 months? If we only earned a 4% interest rate on that, we would still come out ahead. Okay, we would earn more in interest than what we were paying. Okay, now here's why this is powerful. Because if we are in a situation where we're liquidating the cash, we're obviously not earning anything on that cash. We have our interest payment still, but we're not earning anything on the cash that we liquidated. The same is true if we liquidated an investment. It's not growing for us anymore, right? So when we use the $20,000 only as collateral, we take out the loan, we can pay a higher interest rate on that loan than what we earn inside the policy, and we still come out ahead. Now, here's where it becomes even more powerful, because currently the interest rates are about 5% to pay back that loan. So it's even better than the 6% we were looking at. And the earnings rate of the dividend inside the policy is actually about 5% as well. It was 5.2% last year. So we'll use that. Okay. So now it looks even better. We're earning money on that even as we pay back the loan. Okay. And we earn it on the full $20,000, even the money that we borrowed, right? So this is why it's so much more powerful to use a dividend-paying whole life insurance policy than it is to borrow money or to use a savings account or to even liquidate another asset like a mutual fund or stock. Okay, so as we look at this, we're going to continue to show more examples of how we can use these policies and how we can come out ahead every single time. And we'll show the flexibility, the number of different ways that you can do this. All right, hopefully that helps you understand why a dividend-paying whole life insurance is really a powerful tool and why it's the best tool to do that sort of thing. If you like what you hear, please continue to follow along. We're going to continue to dig deeper on what private family banking can look like and the different ways that you can use it. Please like the video, share with your friends, subscribe to the channel, hit that notification bell so that you get a notification every time we drop a new video. Again, I'll put my contact information and our website on the show notes in case you want to learn more that way as well. Until next time, we'll see you.